If you've got a few $1,000,000 invested, chances are someone's told you that you're well diversified. You've got stocks, bonds, maybe some real estate, maybe even some alternatives. And on paper, your portfolio looks like a beautiful pie chart. But here's what I've seen in my advisory experience. You can be perfectly diversified on paper and still be dangerously concentrated in areas that can actually do the most damage. Things like taxes, lawsuit, liquidity risk. The idea of diversification has become so dumbed down over the years to just mean own more things. But that's surface level thinking. Today, we're going to talk about what true diversification looks like at the highest levels and what it has very little to do with just buying more ticker symbols. So when I look at a new client's portfolio, one of the first things that I check for is tax concentration. It's one of the biggest risks, and it's almost something that nobody ever talks about. Many people have the vast majority of their wealth sitting in tax-deferred accounts like a 401k or an IRA. And that feels safe. It feels diversified because they're holding a bunch of things inside there. But in my view, what you're really doing is making a massive one-sided bet against the IRS. You're betting the tax rates in the future will be lower than they are today. And when you need to start taking money out of that account, what if you're wrong? All the growth that you've been pursuing for years could get hit with a much bigger tax bill than if you ever had just paid up front, or a bigger tax bill than you may have ever planned for. I wouldn't call that diversification. I'd call that concentrated risk hiding in plain sight. It's not just about what you own, but how you own it from a tax perspective. You want a mix of tax-deferred, which is your 401ks and IRAs, tax-free, which are your Roth accounts, and taxable, like brokerage accounts. It's like having 3 different buckets of water for a fire. You don't want all of your water in one bucket that the government has claim on. You want different buckets that can access different things at different times for different purposes. Your tax-deferred accounts are subject to future tax rates, and as mentioned earlier, means that you are betting that the rates for you will be lower in the future than they are today. Your tax-free bucket is, for obvious reasons, a nice spot to have your money as it grows, tax-free, and then pulled out tax-free. The problem is you pay taxes up front. And then the taxable bucket is where you have some of the most flexibility and tax control. And I believe it's the best place for you to use tax reduction and tax efficient strategies. You may be thinking, well, that's nice as far as tax diversification. I've heard this before, but what else is diversified in your financial life? What about your advisors? Now, this brings us back to what we've talked about before in smart silos. About your team is likely diversifying things on their own, but they're only doing it in their own lane. So your investment advisor may be focused on diversifying your portfolio. They'll put you in some 60-40 stock bond mix in your IRA. They'll put the exact same 60-40 mix in your brokerage account and the exact same 60-40 mix in your Roth account. It's a very cookie cutter approach, and honestly, in my opinion, pretty lazy. Meanwhile, your CPA is focused on diversifying your deductions for this year, and your attorney is focused on diversifying your assets across different legal entities. They're all doing their job, but it's very uncoordinated, and those moves can cancel each other out. A great investment decision might create a terrible tax outcome. A smart tax move could create legal risk. Without coordination, diversification is one area that you can actually increase your risk in one another when you're looking at your advisor diversification. As a financial advisor, it's most fitting that I discuss the 60-40 portfolio that your advisor has you in across the board. And I understand when I say 60-40 that you may be closer to a 90-10 or an 80-20. I'm just referring to the stock bond mix that you have across the board in all 3 types of accounts. It's just lazy and tax inefficient. You should be using each account for its unique advantages. Your taxable brokerage account can be used for more tax efficient strategies. You want to create capital losses or even ordinary losses in these types of accounts, not create capital gains and higher tax bills for yourself. Your tax deferred accounts can be used for higher growth or income producing assets that you don't want to pay taxes on today. And your advisor might want to sell a winning stock to rebalance, and that could create huge capital gains and a bigger tax bill for you. Now the CPA has to deal with that, a bill that could have potentially been avoided with a more coordinated strategy. Now, I know this is a little bit different way of thinking about diversification than you may be used to, but most of the financial world is focused on just one thing, your investment portfolio. But as you can see, that's not the only piece of a much larger puzzle. At my firm, this is the world that we live in. We specialize in looking at the entire picture, the investments, the taxes, the legal structure, and making sure that they're all working together. We act as the financial coach for a select group of families and business owners who are ready for a more comprehensive approach. If you're watching this and realizing that you own strategies that may have some hidden risks or coordination gaps that we've talked about, then this is a conversation that we should probably have. We can't work with everyone, but if you're serious about building a truly diversified wealth plan, you can book an introductory call using the link in the description. Now, let's talk about what true diversification actually looks like. If just owning more stocks isn't the answer, then what is? In my experience, the wealthiest families and the ones that I work with think about diversification at a strategy level. It's not just about ticker symbols that they own. They're asking deeper questions. When will the assets be taxed? How is it owned? Who controls it? How does this pass on to the next generation? They're diversifying across taxes, legal, asset protection, and even different types of income. It's a much more sophisticated approach, and it requires a coach to make sure that all these different strategies are working together, not against each other. When I say tax diversification, I'm referring to the taxable, tax-deferred, and tax-free accounts. When we're looking at entity diversification, owning assets in the right trust or business structures. When we're thinking asset protection, it's separating personal and business assets to shield from lawsuits. And then the income diversification is just creating different streams of income for retirement. This is not something that you can do in a do-it-yourself, with a few ETFs. It requires a team of specialists who are all coordinated and working together and that are coached by a central strategist. This is the difference between just having a portfolio and having a comprehensive wealth strategy. So look, here's the bottom line. Diversification isn't about owning more things for the sake of it. You want to be owning the right things in the right way, in the right places, and having access to them at the right time. And that requires coordination, not just diversified portfolio. It requires a financial coach who can see the whole field and make sure that your investment plan, your tax plan, your legal plan are all working together as one cohesive strategy. If you're a business owner and you're starting to realize that your own plan might have some of these hidden concentration risks, or maybe your advisor's a little too diversified, I invite you to take the next step. Click the link in the description to book a call with me and my team, and we can explore a coordinated approach and see if it might be a good fit for you. No pressure, just a conversation. Thanks for watching, and I'll see you guys on the next one.